Good morning and good evening and welcome to this British Malaysian Society webinar here on the 29th of September. So capital markets update, IPO opportunities in London for emerging international companies. So people are just signing in now and coming in. So most welcome to everybody. My name, if we can have the next slide, please, Joshua. My name is David Stringer Lamar. I have the honor of being the head of the International Trade Group here at the British Malaysian Society. I'm also managing director of Fortis Consulting London, and we connect businesses in the UK and internationally. And here you'll see, as ever, so I'm going to show you my tie that I have, the British Malaysian Society tie, just landed, so do get in touch should you want to have one of those. Now, we've got an all-star cast for us today. Experts galore. We'll be having the various presentations from the teams, and then we'll be having the questions and answers towards the end. This session is being recorded, and you will hear me giving our expert panel a 3-minute reminder and a 1-minute reminder as we go through. And it's not me grading them in terms of vote and interest on what they're actually saying. Part of the tech team today, we have Stephanie Chung and also Joshua Verghese, one of our student members from the University of Warwick. And in fact, Joshua, if I can hand over to you now to take us through the housekeeping, please, Joshua.
Yeah, thank you, David, and good evening and welcome, everybody. So please let us know who you are and where you're dialing in from today from typing in the chat box, and do let us know what businesses you are, because this is a great event to connect each one and network with everyone as well. So there are 3 primary ways everyone can engage today. So many of you might have discovered the chat function from either this event or previous Zoom calls as well. It's recommended that you change the audience to say all panelists. So in the chat option at the bottom, there is an option to change it to all panelists and attendees, so you can interact with each other as well. If you have a question for the panel that may come up throughout the event, please put it in the Q&A box, which will be responded to at the end after the event. We recommend using the Q&A function for specific questions, because we'll not be checking the chat for questions. So primarily use the chat to connect with people and express what businesses you are, and in the end, connect and hopefully make some new colleagues or new friends. So that's all it from me. Thank you from my end.
Excellent. Thank you ever so much, Joshua. Seamlessly and expertly done indeed. So do get in there in the chat. Let us know who you are, what companies you're doing, and putting your LinkedIn connections, etc. And do get those questions coming in, and do vote for them so we know which are the most popular. It's now my complete pleasure to invite our illustrious chairman, Maysum Lai, OBE, DL, to address us. Maysum Lai.
Thank you very much, David. Ladies and gentlemen, greetings from London, and a very warm welcome to our Capital Markets webinar from me, and also from our president, Sir Mark Moody Stewart. I have been heavily involved with the City of London, the business city and the civic city for 30 years. I have the honor to be the first master of the worshipful company of world traders, who is Chinese and Malaysian. And I'm sort of master of the livery company, and the first one in the 800-year plus history of the City of London. So I support the Right Honourable the Lord Mayor, whose job is to promote UK PLC around the world, in particular financial services. So I'm pleased that today BMS is helping the Lord Mayor and the city with the promotion of financial services and legal and professional services in the UK. I can think of no better place than to list on the London Stock Exchange. And I can think of no better team than the experts we have today to update you on the key issues and the key considerations. So hope what you find what will be coming next of interest and useful, and speak to you later.
Excellent. Thank you very much, Maysim Lai. It's now my great pleasure to invite Ollie Fox of the London Stock Exchange to address us. Ollie, over to you, sir.
Great, thank you. And good evening to those of you in Malaysia and the surrounding region, and good morning to those of you who are in London. Could I just firstly express my thanks to the British Malaysian Society for inviting the London Stock Exchange to speak at this event. If I can introduce myself, I'm Ollie Fox. I've been with the London Stock Exchange Group since 2012. I've recently moved out to Southeast Asia, where I'm based here in Singapore. I'm here to represent LSE's primary market activity in the region, and I'm working with companies and looking forward to working with many more that are looking to develop and grow through raising capital. In this presentation, I'm going to give a bit of information about the London Stock Exchange, why it might be of interest to international companies in the APAC region, and also some updates on what's been going on in markets over recent times. Next slide, please. Thank you. The London Stock Exchange Group spans three principal areas of the financial markets ecosystem. Capital markets, supporting capital raising and trading. Information services, covering indexing, benchmarking, and analytical services. And also post-trade services in risk management and clearing. There's some big numbers for you in the statistics on the slide on the screen, with $10 trillion raised on the LSE in the last decade. $16 trillion of assets under management using FTSE Russell benchmarks, such as the FTSE 100, representing the largest 100 companies listed on London markets. And finally, a mind-boggling 1.2 quadrillion in notional value of derivatives cleared by SwapClear, part of LCH, London Clearing House, in 2019. Next slide, please. The LSE is international in its very nature, with a staff of 4,500 employees in 18 countries around the world. Companies choosing London as their listing venue operate in 108 different countries, including a number of countries in the Asia-Pacific region. And London attracts overseas investment, providing a diverse potential investor base. Next slide, please. Okay, so the world's most international market. I've got a few pictures on the screen here of the scene inside the London Stock Exchange during more normal times for the market open ceremony, with guests invited to take part in what is a significant moment of the public market listing. Included here on screen, May Air Group from 2015, a clean tech company from Malaysia, Huatai Securities, listing via the Shanghai London Stock Connect, and Jasa Marga, road toll operator in Indonesia, who raised the first Komodo bond listing in London. It's worth checking out some of the videos on LinkedIn and other social media of companies taking part in the market open ceremony, where there's a big symbolic red button that's pressed, the countdown completes, trading prices begin to swirl around the exchange's atrium. Clearly a very exciting time for those involved, as you can see from the faces on the screen. However, I can just tell you a little story. The most exciting one of these for the staff at the LSE was probably when the Hypnosis Song Fund listed. Nile Rodgers, who's co-founder of the fund and musical legend, performed a few of his classic tracks with his guitar for the staff, including We Are Family and Good Times on the LSE balcony. You don't see something like that every day, and I don't think this is a signal for me to start singing to remind you of what these songs are. They're some of the most well-known songs ever to exist. However, if you want to bring it up in questions, I could always give it a whirl. Next slide, please. So this slide shows the depth of partnership between Asia-Pacific corporates and the LSE. $40 billion raised in the last 10 years, with 168 companies currently listed on London, worth a combined $1.5 trillion in value. Lots of names on there I'm sure will be familiar to many of you in respect of both very large global players and also more relatively modest sized companies that have chosen London as their listing venue. Next slide, please. Okay, so why London? Next slide, please. What I wanted to cover with you now for this presentation are the kinds of considerations that make London the choice of venue for so many international companies, as well as some updates on recent market activity. So the topics are the international exchange, resilient investor sentiment, globally diverse investor base, valuations that can be achieved in London, liquidity on the London market, specific opportunities for technology and green and sustainable companies, as well as choices of routes to the London markets. Next slide, please. Okay, so firstly, LSE as the home of international issuers. London is very much an international exchange, with 38% of listed companies on London being international, making it the #1 exchange for number of foreign listed companies. I think it's very interesting to note that this is not a trend that is slowing down, with also 38% of 2019's new listings being international. Whereas many exchanges take a more domestic focus, London continues to look globally. Next slide, please. Okay, now this extends to dual listed companies as well, with more than 25% of all companies listed on London being dual listed or traded on other exchange venues. Dual listing improves both companies' share liquidity and its public profile because the shares trade on more than one market and most likely across different time zones. When markets in Asia are closed, London is open, and vice versa. Dual listings also enable a company to diversify its capital raising activities rather than being reliant only on its domestic market. Next slide, please. If we look now at resilient sentiment, we can see how London has performed against other European exchanges so far in 2020. There's been significantly higher levels of capital raised in London than any other European exchange, as you can see from the chart. In total, $33.3 billion has been raised in London so far this year. This has largely come in the form of supporting existing issuers through follow-ons. The opportunity for good companies to return to the market for capital at this time has been possible in London. You can see in the table that Compass Group, a contract food service company for those who aren't familiar with it, was able to raise a further $2.4 billion earlier this year. After a slow start to the year following the emergence of the pandemic, we're now seeing significant IPO transactions, with the largest and most recent being the Hut Group, raising $1.9 billion, and then through the London Shanghai Stock Connect, a new listing for $1.8 billion for China Pacific Insurance. In total, there have been 40 new issues on London so far this year, of which 18 would be classified as an IPO rather than a reverse takeover or a transfer between London markets. Next slide, please. Here we have some additional information on follow-on activity, with some 296 deals between the beginning of March and the end of July, raising nearly £20 billion. There has been significant capital raised for both main market and AIM companies. On the AIM side, fashion retailers ASOS and Boohoo have both been able to raise over $200 million. And you'll see from the percentage of the companies sold in the chart there, that these are both significant size companies that choose to be listed on AIM rather than the main market. Next slide, please. Okay, if we now turn to the diversity of investor base, we can see a comparison here between London and the US. While the US is a more domestically focused market with 85% of top investors domiciled in North America, London has a significantly more internationally diverse pool of investment. This allows issuers access to a pool of capital that is demonstrated to be comfortable with companies who build internationally facing business models. Next slide, please. Okay, this one's about valuations. What we've looked at here is the value of companies now that have listed over the last 5 years across sectors. We've got a sector by sector split comparing London with Hong Kong and also the ASX. London performs well, providing robust valuations as shown by the highest median valuation across all sectors combined, and achieves a premium in some areas. Next slide, please. Oh, one back, please. Great, thanks. At this point, I wanted to give you a bit of detail on recent trading activity on the London market to see the impact of volatility following the emergence of information around the potential impacts of the global pandemic back in early March. There's two charts here, one on volumes and one on value traded. You can see that in respect of number of trades, in mid-March, an all-time high was achieved of 2.9 million daily trades. So 2.9 million trades that day, surpassing the levels experienced back in 2016 when the result of the referendum on the UK leaving the EU was announced. Following this spike in activity, we've since witnessed a return to more normal trading levels. Next slide, please. Thanks. Now I'd like to touch upon a couple of other interesting aspects of listing on the London market. Firstly, and you may have attended the recent presentation for the British Malaysian Society by my colleague Adrian Rimmer on LSE's activity in sustainable finance. However, to recap, one element of this is the green economy mark. This is available to companies that generate greater than 50% of their revenues from sustainable activity. 86 companies split across both the main market and AIM and worth between them £86 billion now have the green economy mark. These have outperformed the wider universe of listed companies on London, driven in part by investor appetite for supporting such sustainable companies. Next slide, please. Okay, moving to technology. Given the reputation of NASDAQ as the home of technology companies, I think it's worth pointing out the significant representation of the technology sector in London, with 185 companies worth a total of $158 billion. You can see a number of names that will be familiar to many of you, I'm sure. And we've also got a chart tracking the share price performance since August 2010 of technology companies versus all companies listed on FTSE All Share. Next slide, please. So, notwithstanding that, given technology represents a relatively small 11% of the total market capitalization on London versus 26% in US markets, there remains an opportunity with London investors due to the effective scarcity value of such companies and investors wishing to reweight their portfolios towards technology securities. I should just say that these slides, there's a lot of information on them, will be available later for those who request them. Next slide, please. Finally, I wanted to give you a bit of further information on the available routes to the London market. Next slide, please. Okay. This slide helps us see the capital raising life cycle for a company looking to grow on the London markets. Elite, covering early stage, is the LSE's international business support and capital raising program for ambitious and fast-growing companies. It's an ecosystem to help private companies scale up, structure for the next stages of growth, and access capital. Companies become part of the vibrant community of entrepreneurs, advisors, investors, and key stakeholders. Part of its remit is to bring people together. Now, Elite has been largely European focused during its initial development, but is now expanding into the Americas, and Middle East, with further expansion plans coming up. Next, AIM, the alternative investment market, is LSE's market for more than 950 high growth companies in 90 global locations. It has raised over £100 billion for companies since inception 25 years ago. Moving to the main market, which is generally for larger and more established companies, there is the premium segment for listing of equity shares for companies that comply with the UK's highest standards of regulation and corporate governance, which means that they can enjoy a lower cost of capital through greater transparency and through building investor confidence. The standard segment is also open to global depository receipts and debt securities, allowing issuers to access the main market by meeting EU harmonised standards.
3 minutes courtesy reminder.
Thank you. I should just mention, as it's on there, the high growth segment is a segment of the main market designed to assist mid-sized European and UK companies that require access to capital and a public platform to continue their growth. Next slide, please. Thank you. So here we can see some of the main differences that may impact a company's decision to list on AIM versus the main market. Possibly for some companies, the most important are the share of company that needs to be made available to trade on the market and the length of time that the company has been operating. However, there are also differences in regulation and governance requirements that may make AIM a more suitable option for some. Next slide, please. Okay, lots of detail on this one. The bit further information on the differences between the market segments and the process of listing. And I'm sure many elements of this will also be covered in the following presentations today. One key difference with the AIM listing is the requirement for a nominated advisor, or nomad. A nomad is responsible for advising and guiding a company on its responsibilities in relation to its admission to AIM, as well as continuing obligations once on the market. Clearly, for companies or management making their first listing on the London market, this role might be highly beneficial in concluding the process. Next slide, please. Sorry, standard disclaimer. Last slide, please. Thank you. Thanks very much for taking the time to listen to this presentation today. Much appreciated, and I hope that you found it useful. I look forward to helping with any questions either at the end of this session, or if you prefer to get in touch directly to discuss a possible London listing, I'd be delighted to do so. My contact details are found here, and I believe along with these slides will be made available on request from the event organisers. Again, thank you very much.
Excellent. Thank you very much, Ollie. You covered an enormous amount of ground there, and in fact, you've triggered off 6 questions. So that's remarkable, and also you stuck within the time. So even better. Congratulations for that. And you've also said that the material, the slides, will be available because that was one of the questions that was raised. So thank you very much for that. I took away from that why London, international resilience, investor sentiment, diverse investor base, liquidity, and choice of route to market. You also drew our attention to 40 new issues on LSE this year. And at the moment, there are 185 tech companies. I didn't realize there was that many actually on the markets, and route to market, elite, AIM, and main market. And of course, you did offer in the questions and answers to possibly sing some of the songs that you heard at one of the opening bells, but we're not sure. We'll see how popular that is with the attendees at the moment. So terrific. Thank you very much, sir, for that. It's now my pleasure to introduce Joe Turner, Cairn, making the most of a London listing. Joe, over to you.
Hello, good morning, good afternoon, everyone, and yes, thanks for being here. So I've been asked to provide a little bit of an overview of making the most of London listing. And let me start with a bit of the background of who I am and why I might be able to do that. But I do feel I'm probably doing myself out of a job. I can do that in 10 minutes. What I will do is I'll pick up on a couple of the key themes that we've seen over the last sort of 10, 15 years. So I'm a partner of a financial advisory business. We are principally nomad. And as you might have heard with Ollie a minute ago, a nomad is sort of the retained advisor who looks after companies on AIM. We also work across a range of markets, and we do takeover code and an M&A transaction. So we are embedded in sort of the London equity capital markets at these sort of the smaller to mid-size end, so in that sort of under 100 million market cap. I may go to the next slide, please. And to the next one, please. Okay, so having a think about the key aspects to making a successful listing, first thing I'd say is slow down. Right from the outset, try and understand what it is that you want from the market. So know yourself and know the markets. And without any discredit to the LSE, of course, there are other markets in London. And each of those come with a range of sort of regulatory challenges or hurdles, requirements, corporate governance oversight. The rule book is similar but different. And also the costs of entry are different. As a second point, I would say, make sure you understand who your audience is. So what are the reasons why you're coming to the market? If you're coming, which most people are, to raise money, then it's important to concentrate on who the prospective investors that you're targeting. Some companies do come to raise profile, some come to get closer to potential customers and clients. In each case, understand which market suits those needs better. I would say one of the biggest challenges we've come across is with overseas companies. And if I may generalize for a second to say that probably most people on here are either involved with a company based overseas or have operations overseas from London. So considering the target audience attitude to your risk is absolutely vital, because in each case there is something that you can probably overcome during the structuring or the presentation of your business as you prepare it for the market to overcome these challenges. The biggest problem we've seen in the past has been that sort of automatic presumption of a trade-off between risk and reward. And actually, when we're in a bull market, there is really a maximum tolerance for risk that investors are prepared to take. So no matter how high the return and the market opportunity, that needs to be brought back in line with commonly accepted risks. They'll happily take your return, but not the risk that goes with it. So factor that in. I'm going to start off saying these 5 Ps, and I'll come through this talk to say, just think about it, consider it carefully, don't rush. When you get onto the market, keep up with the regulation, make sure you're on top of it. You've really got to take this to heart because it's not going to go away. And performance. So under promise, over deliver. Track records really do matter. Next slide, please. As you step through the sort of IPO process and you start to engage, I'd probably say you go from the consideration to the planning phase. And with this, each company that comes is required under whatever market applying to adhere with certain rules. And the most common ones at the moment are sort of corporate governance rules. And every year, these get a little bit more stringent for very good reasons. So we would say, come as a good pupil. Make sure you understand the rules. Put these in place ahead of time. Don't leave it to the day that you join a market, because actually that's not really ingrained in the culture of your organisation at that point. So look at a board. Understand you've got good people around you who are going to challenge the directors. Very often with overseas companies where you've got family-run businesses, you come with a very strong entrepreneurial culture. But part of being a public company, like a public market, is you have to remove the presumption of a private company, public market attitude, being led by a dominant individual or a family of people, and making sure that everything that's done is fair, and it's balanced, and it's considered. And that's the role of the board. So I would say plan ahead of time. Make sure you identify key people, not people who are just going to say yes to what you want, but people who really help drive that business and challenge some of your assumptions. You have to consider the company as a shop window, as it says there. So coming to market, people forget that everything becomes very, very transparent. You will have, greater accounts disclosures. You've got to have website disclosures. Every piece of information, whether it's good or bad, that's price sensitive, has to be put out to the market in a timely fashion. So, again, plan ahead as to how that's going to look. What events do you have that are coming up that you need to work around, whether there are, preparation for events in the wider economy that might affect you, to actually so events in your own company. And always go for the best possible presentation. If you're coming into a market trying to raise money with investors who don't know you very well, and they may not know a lot of the directors very well, then it's the small details that do matter. You know, first of all, they have to actually want to take a meeting, and in these days of using video meetings, make sure the presentation's accurate, that your company information is accurate, your numbers are correct. Because if you start missing these at the early stages, then it's only going to get harder later on. They might not take the meetings. Think about capital structure. Again, we've sort of spoken about the entrepreneurial culture, and so that often the companies are structured in such a way that where there's a group of shareholders or a shareholder who's significant. Try and think ahead of time how those holdings can be broken up and what looks attractive. On any market you apply to, if you had an 80% shareholder or a family holding, that's not that attractive because you're not going to have a lot of free float. You're probably not going to be able to sell down. You're going to find there are challenges along the way that level of control raises concerns from investors. A very key topic is valuation. It's always the one that people dwell on. How much can I raise? How much can I get for it? What we've seen over, certainly I've seen over the past, say 10 years, is that driving for the best possible valuation actually typically sets a very, very high hurdle rate for companies when they come onto market. So on the assumption that a high valuation means you raise less money, which means there's less dilution in your capital structure, which may mean there's more control kept with the founders, that all those risks we spoke about, or I spoke about a few minutes ago, coupled with setting a high bar for delivery, can put pressure on your price. If you leave something on the table for all the investors along the way, well, actually you're stimulating demand. It's fair to say that liquidity isn't really a function of a market. Liquidity is the demand that you generate, the excitement that your company sort of extends to the market. And if that price is absolutely where it probably should be, then you're going to have fewer buyers and you may have more sellers.
3 minutes courtesy reminder.
Thank you. That'll stifle your liquidity. Last one I put in there is a bit of an old saying, but retail provides liquidity and institutions provide solidity. If you have a block of shares that goes out to an institution, they tend to be long only. So they will sit there with that block. It's not trading the market. So it's the retail traders who will buy and sell and move the price on. And it's a group that mustn't be forgotten. Next slide, please. It would be folly just to think about the investors as sort of stakeholders in your IPO, and up on the screen, it's a lot of information there, but it runs through the sort of key components of the stakeholders in an IPO process. And each of these need to be considered carefully because it's not just the advisor you use, but it's the role of the advisor and the information requirements each of those advisors needs in the process. And you'll have to manage that. Whilst managing your business, you're also going to have to provide the information they need in the form they want. It comes back to don't rush. Make sure you can satisfy these obligations on the way through. The nomad, and I've put us there, tends to have a sort of overarching view of the process. And that's the role of the nomad is to coordinate that as well as a specific function. But I don't plan to go into any more on that. The next slide, please.
1 minute courtesy reminder.
Thank you. And the key takeaways I would take from this is the IPO really is the start of a journey. So make sure when you come to market, you continue to embrace corporate governance, you continue to learn, you continue to put your best foot forward. Always maintain a reasonable working capital headroom because you never know when it may be possible to raise money or not. And secondaries, so raising money on the market, is typically easier than raising money coming to market. That's it from me.
Excellent. Thank you ever so much, Joe. That followed on terrifically well from Ollie. We have 9 questions in there, so do upvote the ones that you like out there, people. You talked to us, Joe, about what do you want from the market. Think about this. Which markets suit these needs the best? Make sure you understand the rules. Be a good pupil. You said, I noted your comments on corporate governance resounding through your presentation. Very important. and go for the best possible presentation. And of course, think about what will be attractive for potential investors. And then your closing comments noted as here at the top of the slide, the IPO is just the start of the journey. Joe, thank you ever so much for that. I'd now like to invite Robin Stevens, Crowe, pre-IPO planning and becoming investor ready. Robin.
Thank you, David, and thank you, Ollie and Joe. This is the first presentation that we've done virtually into Southeast Asia, but over the last 15 years, I've done many of these presentations in person. I'm sorry I can't be with you, but it's very good to get the opportunity to see and meet both old friends and new friends. This will just be a brief summary of some of the pre-IPO planning issues, some of which Joe would have covered, and also about being investor ready. Next slide, please. And the next slide. And so I'll try and pick up some of the issues that Joe's mentioned, also talk a little bit more about corporate governance, and just in outline some of the accounting and tax issues that are relevant to a company planning an IPO, or in fact planning any form of external capital raising. I think it's important to say that some of the issues we'll talk about in relation to London in terms of being investor ready and being prepared to carry out pre-IPO planning would be the same on nearly any market, and also in relation to anyone looking for external funding. Next slide, please. I think in terms of moving from a private to a public company, an awful lot of detailed planning is required, and Joe's mentioned some of that, and I'll mention some stuff further on. But the good news is, in accounting terms, there's no reason why any well-managed business cannot evolve from being a private to a public company. As long as the company is able to either has or implements good financial controls and management reporting, has or can recruit an experienced CFO, and is compliant with international financial reporting standards or the local or the local version of those standards, there's no reason why any well-run company could not evolve. So there shouldn't be any accounting issues to stop a company from moving to a public status. Taxation planning is important. That may take a bit longer, but overall, and I'll mention this 2 or 3 times in the presentation, as long as a good IPO candidate can demonstrate quality, good governance and value, there aren't any accounting issues that should delay that process unduly. Next slide, please. Just in terms of Crowe, I'm a senior corporate advisor of Crowe in the UK, do a lot of work with Crowe in the UK, but also around the world, particularly Southeast Asia. And we now have 72 listed clients on the exchanges mentioned there, and probably another 20 or 25 where we're just giving tax or accounting advice, but I have a large track record in IPO work and ongoing work for public clients. Next slide, please. And importantly, many of these clients are international. We have 9 clients currently in Asia Pacific, and a number in the pipeline. And it's a large part of what we do. We're not just UK centric, and bringing international companies to London is a key part of what we've done and what we do. Next slide, please. I won't dwell on this slide, it's been mentioned before, but just as the reasons for AIM, but also the reasons and the benefits of AIM and London markets generally: access to capital, experienced community of advisors, balanced regulatory approach based as much on principles as on detailed rules and profile. And many of the companies that we've worked with in Asia who have been looking at alternatives between Singapore and Hong Kong and London, those who have chosen London often have chosen London for the reason of profile. It gives clients and companies a higher profile to be part of a London market than just a regional market, particularly if their aspirations are to grow internationally. Next slide, please. This is a interesting slide, largely because I stole it from somebody else, but importantly because it gives you the two bits of London, the 2 bits of AIM. In theory and in practice, you can actually achieve an IPO in London in 4 months, and we've done it sometimes in 3 months. The important point, though, is a note at the top of the slide or partway down the slide, and that the pre-IPO planning can take 12 months or 24 months. And like all these things, if you fail to plan, you plan to fail. And most of the most effective IPOs we've worked on are ones where we've worked for 6-12 months on planning the IPO. Once everything's ready, the company's ready, the market's ready, the actual mechanical process of listing is generally quite quick, subject to market conditions. Next slide, please. IPO planning and actually what investors are looking for. Joe's mentioned some of this knowledge to an extent, so I won't go through it line by line. I think the important thing is to talk about on this slide is really talk about the quality of earnings. A lot of people focus on the actual the amount of the earnings, how much the business is making, but actually investors and the market will look at what is the quality behind those earnings, how dependent is that company on particular customers, suppliers, products. So that's a key issue. But again, I'll say it again, quality, good governance of value is crucial. The other thing to mention is international. It's very difficult to actually float a one country company unless it's a gold mine. So any company that's operating in Asia looking to come to London must have at least a regional play. And most of our successful listings that have come out of Asia have been companies which have grown in their own jurisdiction. Particularly Malaysia is a good place to start. Have expanded out into Southeast Asia. They've become regional and will come to London to look for further funding to expand thereafter. So quality, governance, value, and an international story are crucial. Next slide, please. When I did the slide, I actually color coded. I just wish I could remember what the codes meant. But in general, the grey boxes are really about management. The blue boxes are more about commercial aspects. The dark grey boxes are more accounting and structural. And the most important box is the yellow one at the bottom, which says appoint experienced advisors. Some of these points Joe's mentioned, so I won't go through them in detail. They're more of an aide memoir. Probably the two most important boxes or ovals, I should say. Top left-hand corner says strong and complete management team. Without that, it can be quite difficult to convince people that you should be trusted with their money and the business can move forward. And also probably the middle box at the top, having a scalable business model. People are interested in the past, but only to show that there's a sound basis to expand from. Most people invest in the future. So a scalable business model with strong management are probably the two key points. But obviously, joking aside, appointed experienced advisors is also crucial.
3-minute courtesy reminder.
Okay, thank you. Next slide, please. Corporate governance, I'll just mention very, very briefly on why corporate governance is important. It's a direct link from being seen to have good governance to creating confidence in investors. Confidence in investors will demonstrate quality in the market. That will excite investor interest. That will create liquidity, and that in itself will drive value. So governance, particularly on the A market, can't be underestimated. It can't be. It needs to be emphasised. It is in theory very easy to come into a market not having detailed governance procedures. The rules talk about having procedures which are appropriate for a company's stage of development and an early stage for business. You can certainly come on the market having perhaps a minimalist approach. But the best advice is to apply with all the corporate governance that people would expect to see. Next slide, please. And in terms of that governance in the UK, we have the Quality Company Alliance guidelines. They're very clear and really follow the process of ensuring that either a company complies with the rules, where it doesn't comply fully with the rules, because perhaps it's early stage, it will disclose why not. And this process, based on as much on principles, is a good compares well with some of the more detailed approaches used in, say, in the States, where you have Sarbanes-Oxley, which is a very onerous approach and probably not appropriate for many small companies. Next slide, please. In terms of corporate governance, what can go wrong? I won't go through this slide in detail, but the main point is the first point, really. Make certain that when people come to market, as Joe said, you have realistic expectations and perceptions on timing, value, and process are clear. All the other points here are based on examples of things which have gone wrong, but I won't go into detail. But plan in advance and make certain you deal with all the major issues.
1 minute, please.
Next slide. Taxation issues. I've listed here some of the issues to bear in mind. The first point is important. Have a strong historical compliance record, go back and sort out any problems. Going forward, keep the structure simple. And overall, tax is a good thing. Paying tax means you're making profits. So don't over-engineer. Keep the structure simple. Next slide, please. Accounting issues, as I said at the start, there are no real differences between local GAAP and IFRS. There are 4 items here which do vary, but nothing of any great consequence. Next slide, please. Accounting issues, the main one here really is around credit management. To make certain the company's cash conversion from profit to cash is strong. That again will demonstrate high qualities of profits and will show people that you can generate cash, not just paper profits. Next slide, please. And in terms of takeaways, lots of these have been mentioned in the past by Joe and myself. Quality, good governance of value. I think the last one's important. Invest time and effort in the market, and the market will invest time in you. You've got to engage the market, come to market, keep the market engaged, explain what you're doing. Don't just come back once a year with the accounts. Keep investors informed of what's going on, and you'll get real value for the IPO rather than just have the listing without the ongoing benefits of raising funds and interest going forward. Next slide, please. And in terms of Crowe worldwide, we're part of Crowe International, the 8th largest accounting group in the world, and we cover all of Asia, or most of Asia, are very active in that area. Next slide. And those are the principal contacts. So thank you very much indeed. I'm sorry to rush through, but the slides are available, and obviously pleased to take questions at the end of the session. Thank you.
Great. Thank you very much, Robin. Nicely following on from our other two speakers. London gives profile compared to regional markets. I was very excited, as you no doubt meant it. The IPO can take 4 months. You've done it in 3 months, but then you cautioned and said pre-IPO 1 year to 2 years, and you drew our attention to investors looking for quality of earnings. And international, it's very difficult to float a one-country company. People are interested in the past, but really only when they're gauging the future. Tax, keep the structures simple, and you consistently drew our attention to quality, good governance, and value. Thank you very much, Robin. Now I'd like to invite Clive Garston, DAC Beachcroft, the role of a lawyer in the IPO. Clive.
Thank you very much, and good morning and good evening, everybody. And thank you to the British Malaysian Society for giving me the opportunity to talk to you today. Next slide, please. Next one as well, please. Thank you. Something about my firm, DAC Beachcroft. We're a full-service international law firm with offices in all the major cities in the UK, in Europe, in Asia Pacific, and Latin America. And as far as this society is concerned, perhaps most relevant is that we have an office in Singapore. We provide a full transactional and advisory service and have wide experience in all forms of IPOs, both for domestic and non-domestic issuers. Next slide, please. The role of the lawyer in an IPO. Well, simplistically, to ensure compliance with all relevant legal requirements. IPOs are heavily reliant upon lawyers, and those lawyers have to be well versed in securities laws and understand the legal and practical issues that come into play when a company is engaging in an IPO. The lawyers need to be aware of the interests of all stakeholders, who are primarily the company, its directors, its shareholders, the sponsor or nomad, and the brokers. And it's not only securities laws which are relevant to the legal process, but many other areas have to be looked at. For example, intellectual property, real estate, maybe employment, share incentives, pensions, banking, and others. The lawyers need to understand the company, its business, and the sector in which it operates. Turning briefly to pre-IPO restructuring, which is something that Robin has also spoken about. It is necessary to identify changes the company needs to undergo prior to the IPO. These will probably be changes needed to the corporate structure to prepare the company for a public listing. It may involve the imposition of a new holding company, which could be in the UK or possibly more likely in the Channel Islands. There will need to be changes to the share capital structure. In many cases, private companies have more than one class of shares, and this is generally not permitted in a quoted company. There'll almost always be a reorganisation of the share capital to ensure that the right number of shares are available at the desired issue price. And there'll be another number of other relevant legal documents to be dealt with, There'll be a need for new articles of association or whatever is the constitutional document to ensure that it's appropriate for a public company, a placing agreement, service agreements, etc. But I don't think there's any time to go through all those today. Next slide, please. Turning to due diligence, this is one of the most important things that a company's lawyer carries out in the IPO process. It is a key part of the process of preparing any company for an IPO, and it's a full investigation of the company's business and the process of identifying and assessing all legal risks associated with the company. It's a top to bottom review of all areas affecting the company. And due diligence for capital markets transactions is the most vigorous kind of due diligence. It calls for the highest level of scrutiny since it deals with raising money from outside investors, and it's aimed at preventing any form of disaster or mishap. The legal due diligence process will commence with the company's lawyers sending the company a long and detailed list of questions seeking information on all matters relating to the company. For example, does it have any borrowings? Has it properly protected its intellectual property? Has it granted any charges? From the company's point of view, it's essential that the right people deal with the legal due diligence request, and in my opinion, very sensible for the company to designate a lead person at the company to take charge of the process, and also to ensure that the lawyers are asked for that due diligence request as early as possible in the proceedings, so that all relevant information and documents can be brought together. Once the law firm receives the answers to this request and the documents, it will inevitably raise further questions and a request for more documents and probably a number of meetings with the company. When this is all finally collated by the lawyers, they'll write a detailed due diligence report, which will be addressed to the sponsor or nomad and the company. And this report will highlight issues that they've established, any remedial action that needs to be taken, and will probably give them a traffic light identity so that red items need to be addressed immediately, amber items as soon as possible, and the green items not being quite so important and can probably be dealt with after the IPO. Examples of a red light issue might be that a company is in breach of its banking covenants or there are defects in the protection of its IPO. This exercise, as I've said, is very thorough and comprehensive, and it reduces the possibility of liability for errors or omissions in the prospectus or admission document. It can identify issues that need dealing with, and it also helps with the drafting of the prospectus or admission document. Next slide, please. Going hand in hand with due diligence is verification. And this is a process whereby all statements in the admission document or prospectus are checked to ensure that they are true, accurate, not misleading, or based on reasonable assumptions. This process is painstaking, boring, and laborious, but it's done to protect the directors and to ensure that there are no mistakes and that they do not run the risk of any criminal or civil liability for any misstatements or relevant omissions from the prospectus or admission document.
3-minute courtesy reminder.
Thank you. Detailed line-by-line analysis of the document takes place, together with the production of full verification notes. And this verification is carried out when there is an almost final draft available. So it's something that happens late in the process. Next slide, please. The non-executive director and corporate governance. In law in England, there is no distinction between different categories of directors. All directors are required to comply with all relevant provisions and meet the required standard of conduct when performing their functions and duties. It is, however, established practice to classify directors according to the different roles that they perform. Executive directors have an involvement in the day-to-day management of the company and are probably in full or part-time salaried employment. Non-executive directors do not get involved in management. They are in more of an advisory capacity. They are independent of the company, and by independent, I mean they don't represent any shareholders, they don't have a direct or indirect interest in the company, they're not employed by the company, and they're not a member of the immediate family of any executive directors or any controlling shareholders. As has been mentioned previously by other speakers, any company whose shares are quoted in London will have to adopt a corporate governance code. It will be the QCA code for small or medium-sized companies and the UK corporate governance code for larger companies.
1 minute cursory reminder.
And well, finally, just to wrap up, it's not an easy role being a non-executive director. I know this. I've been on the boards of a number of public companies, both as a non-executive director and chairman. And remember, when a company succeeds and does well, nobody gives credit to the non-executive directors. But when there's a problem at a company, fingers are pointed immediately at the non-executive director and the chairman, and they become the subject of criticism. So it's very important that the non-executive directors exercise their role of challenging the executive and ensuring that the company is properly governed and run and managed with a view to increasing shareholder value. Next slide, please. Well, thank you very much, everybody, for giving me that opportunity for a short run through. If anybody wants to ask any questions at the end, I'd be delighted to answer them. And equally, if you want to contact me afterwards with any questions we don't have time to deal with today, you have my details. Thank you.
Excellent. Thank you very much, Clive. You talked about ensuring compliance with legal requirements, pre-IPO restructuring, due diligence, purpose, identify issues, and a top tip there, designate a lead person at the company, verification, check accuracy, and then you kindly talked about the importance and the roles of non-executives within the company structure. And I'm taking away, make sure you get the right legal advice, the right lawyer, the right law firm. Thank you very much. We've got 16 questions at the moment in the questions and answers, so do vote for those. There's lots of activity going in the chat, lots of sharing. Just to remind you, or possibly inform you, in the chat, if you look at it, there are 3 dots, dot, 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 and you can actually save the chat. So you don't have, if you don't have time at the moment to work through all that and all the different connections, you can save it to your computer and go for it later. As Joshua said, this is a great way of connecting. Okay, on to our next speaker. So Gavin Wilkins, Hawksford, Structuring for London IPOs and Related Considerations. Gavin, over to you.
Excellent, thanks David. Good morning, good afternoon, good evening, wherever in the world you're dialing in from. For those of you who don't already know me, I'm afraid there's probably no prizes for guessing that that's me on the next slide. Next slide, please. Next one. There we are, that's me. I'm Gavin, I'm a member of the leadership team at Hawksford. And for those of you who don't know Hawksford, we provide private wealth, corporate and fund services from 11 international offices in Europe and Asia. And if that picture of me isn't unsettling enough, then 2020 certainly has been. In fact, the last few years have been pretty extraordinary. What does the future hold? Who knows? I certainly don't. But one thing I do know is that in uncertain times like these, we need to make sure that we constantly review and plan our corporate structuring to make sure that it's fit for purpose and as future-proof as it's possible for it to be. Some things do remain certain though. London is home to some of the deepest pools of capital in the world, and London has an enduring appetite for emerging international companies and those from the APAC region. So with all of that in mind, we're going to have a whiz through restructuring using an international holding company, where to put that holding company, and some of the broader structuring considerations. And we'll also touch briefly on Islamic Sukuk issuances through the London Stock Exchange. So let's get straight into that. Next slide, please. So an international company coming to London is usually going to consider forming a new group holding company to act as the listing vehicle. And in practical terms, we see that happening in one of three ways. The first is the most straightforward, where we're dealing with an acquisition company. So that's a company set up specifically to raise capital to identify and acquire an existing business. That's straightforward because we're just forming a new company from the outset. More often though, we're probably going to be dealing with an existing business that's already operating internationally. In those cases, we'll introduce a holding company to the existing structure. So that does involve a group reorganization prior to listing. And typically that's going to involve a share-for-share exchange, whereby the existing shareholders will give up their shares in the existing business to the new holding company in return for shares in that holding company. The third scenario is probably a bit more unusual, but does happen. And that's where you have an existing holding company in place, but it's probably not in the right place. So that might be a legacy of some outmoded tax advice from 20 years ago. But if you're looking to come to London and you need to relocate or migrate that holding company to a new jurisdiction, you can do that. Or more simply, albeit more crudely, it may be possible to just bolt another holding company on top, which I've seen done. Next slide, please. Now, whichever of these roads you go down, you're going to end up with something that looks broadly like this. At the top of that structure is the holding company, which that's the company whose shares are listed on the stock exchange, and they're traded through CREST, which is an electronic stock transfer system. Below that, you've got the operating company. In this example, that's in Malaysia, but it could be anywhere really, with various international subsidiary operations. Now, the operating company will continue to operate as normal and continue to be liable to tax in its home jurisdiction. The holding company, meanwhile, will be established in an appropriate international finance centre, which is tax transparent, so it's not adding any additional frictional tax burden. Next slide, please. So the next obvious question really is where that holding company should be established. Now, if there's going to be significant economic activity or income generating activities in the UK, then as Clive said, it may make sense to incorporate that as a UK company. But that's probably less likely to be the case for an emerging international company, and in which case you're going to look to utilise an appropriate international finance centre. Now, days gone by, probably wasn't much of a decision, probably anywhere cheap and cheerful would have done, to be honest, but things have changed, and we've now seen increased scrutiny on economic substance and the credentials of the holding company jurisdiction being analysed a lot more closely by investors and their advisors. So actually, this is an area where investors and advisors like certainty. So getting this decision right is probably more important than it might first appear, particularly in uncertain economic times. And let's face it, if you're pitching to investors, you don't really want to spend half your pitch justifying your holding company location to them. You'd probably rather be promoting your business. Now, if we look at that graph, that tells us a number of things. It covers the London Stock Exchange and AIM, and you can see that the market capitalisation in billions of Jersey-based holding companies vastly exceeds those of other international finance centres outside the UK. Next slide, please. And in fact, there are actually more Jersey companies in the FTSE 100 and on AIM than any other international jurisdiction outside the UK. They're listed on stock exchanges from London to New York with a combined market cap of coming up to £300 billion. At the bottom of the slide, there's some well-known Jersey companies that are listed in London, so a few logos that hopefully are familiar. Next slide, please. So why is that? Well, why Jersey? Well, I suppose the first reason is pretty obvious, and in fact it's probably so obvious that I forgot to put it on the slide, and that's that Jersey is physically close to London and it operates in the same time zone. That's obviously important when you have London-based non-executive directors who who need to travel to Jersey and attend board meetings. It's about an hour's flight, probably more like 10 or 15 minutes if you've got an F-16. And there are loads of flights, so it's all very easy. Perhaps more importantly, though, is the level of integration between advisors in the City of London and service providers in Jersey, which allows them to work seamlessly together as a transaction team. And I'd say that's vital for any cross-border deadline-driven transaction, and an IPO like this is no different. On the slide, I've listed out other main sort of technical factors that Jersey has in its favour, and I won't go through them, but it is worth noting that the OECD and IMF rate Jersey as a cooperative and sustainable finance centre. It has a AA- rating. The tax environment is straightforward and predictable, and you can trade Jersey shares through Crest. You also have the protection of the UK Takeover Code, which applies to shareholders in a Jersey company. So what all of that boils down to really is about providing certainty to the investors and their advisors. They trust Jersey and they're comfortable with how it operates. Next slide, please. So other things to be thinking about from a structuring perspective, well, obviously you need to plan ahead for the group reorganisation, the establishment of the holding company and any other kind of restructuring that might fall out of advice that's tailored to your business.
3-minute courtesy reminder.
Thank you, David. And unless you want to go to the time and expense of building your own Jersey company secretarial and admin team, then that's probably something that you want to look to outsource. For the business owners, you probably want to be thinking about your own wealth and succession planning. After all, we are talking about value creation here, regardless of whether there's a partial IPO a partial exit on IPO. And it's always better to consider personal structuring and succession planning in advance rather than after the event when you maybe wish you'd done it differently. Alongside the business itself, common structuring considerations are always going to include ESOP, CBTs and other share incentive plans. And those sorts of structures are really aimed at retaining your employees for the long term, but also as currency for attracting new talent. And they're often set up and managed by an independent trustee on behalf of those employees. Now, these are all areas that Hawksford can help you with. Next slide, please. Now, today is a British Malaysian Society event. Malaysia is obviously a global leader in Islamic finance and banking, so I do just want to touch briefly on this topic. I won't talk through the basic Sukuk program on the slide, but I would just highlight that we've seen a lot of Sukuk being structured through Cayman. But we've also seen Jersey being utilised where there is a London listing involved, and that's probably no surprise because all of the same reasons we've talked about apply. Jersey Sukuk certificates are issued on the LSEG, the Bursa Malaysia, NASDAQ Dubai and Kuwait stock exchanges, and it does add credence, I think, to note that important players such as the Islamic Development Bank have used Jersey within their Sukuk programs. Next slide, please. If you want to read a bit more about that and Jersey's wider Islamic finance credentials, then I did put pen to paper and produce an article which was published in the Islamic Finance News last week. It's a bit too grainy to read on the slide, so please do just email me if you're interested and I'll send you a copy. Next slide, please.
1 minute, please, Gavin.
Thank you. So the key takeaways on the structuring side, there is strong investor appetite in London for growing companies with an ASEAN or APAC exposure. It's common to form a holding company before listing in London. Jersey is very often used, but the key mantra is get it right from the start, get your corporate structuring right, but don't forget about your personal wealth planning. So there we are, structuring in 10 minutes, and I'll end the way I started, which is with a big picture of myself. Thanks for listening to me this morning. Thanks to the BMS for having me, and please get in touch. Thank you.
Excellent. Thank you very much indeed for that. And you nicely brought together many of the themes of our other speakers, talking there about it's important to select the right jurisdiction for the listing vehicle. And then you talked to us about Jersey being a major player, approximately 300 billion pounds worth of companies listed in Jersey, if I got that correct, physically close to London, time zones, very short flights. You mentioned, in fact, through your connections, you can sort out an F-16 apparently for your friends, so that's good. You also talked about strong corporate governance, so that thread that's been running through the presentations this morning, and also drew our attention to the Sukuk programs that are available in Jersey. So thank you ever so much for that Gavin. Joshua, if you can bang up the questions and answers slide, and let's get going. And panel members, if I can ask you now to turn on your videos, unmute, etc. So we'll be in speaker mode. And we've had an enormous amount of questions, and we've had ones coming through as well beforehand, and a lot of those have been answered as we go through. So let's see what the most popular one is on the taxi rank at the moment. So from Jack, there are increasing number of ASEAN tech life science companies that are looking at London as an alternative to NASDAQ listing. However, the default position remains very much NASDAQ or regional markets for tech and life science companies coming out of ASEAN. Is this something that the LSE wishes to target, or is the NASDAQ default too difficult to beat? Ollie, I've got a feeling you might be the man for this one. What do you think? LSE?
No,
life
absolutely.
sciences.
Of course, this is something that we're looking to target, these kinds of companies specifically. I think what I would say is that the London markets, including AIM, accommodate all sizes and stages, which is something that sets us apart from NASDAQ. So that's why it's going to be very worth having these conversations.
Excellent. Thank you. No, good stuff. That's what we like. Well done. So bring it on. Terrific. Let's go to our next one from Jack's Clipsum. Joe, what is the current appetite amongst investors for East and Southeast Asian businesses? Joe, you want to start us off?
I was going to try and deflect the question. I would say Jack probably hits on the sort of topic above, actually. I would say to tech, healthcare, and there's always a resource focus. If we're taking AIM, we're particularly strong companies where there's always a lot of demand.
Great, terrific. Would anybody else like to come in on this one? Current appetite among investors for East and Southeast Asian businesses?
I think David, all I'd say was the point I mentioned earlier. Really, was I think if they're regional businesses looking to expand, then I think there's of interest. If they are currently still just operating in one country, I think that's more difficult.
Great.
Yeah. David, may I add to that? I realise I probably didn't answer the question very, very clearly. I'm sort of answering a slightly different one now. To add exactly to what Robin's saying, there are lots of reasons to make companies attractive. It's not just one sole focus. So structure as well, governance, operations, location. So it probably is taken by a case-by-case basis as well. The easy thing to do is to contact someone on this chat and ask the question for a specific case.
Excellent, great. Thank you very much, gentlemen, on that one. Let's go to Rav here. What are the main advantages of listing on AIM versus the main market? Who would like to start us off?
Is that addressed at me again?
Well done, Joe. Well done.
Okay, so they have two very different rule books, actually, and as tools where they achieve quite similar goals. The whole competition in the markets are different. So, for example, AIM has a quite principle-based rule book, whereas the main market is very subjective. AIM tends to be for growth companies, with the high end of the main market, the sort of premium segment, is much larger established companies. The standard segment also aims at growth companies and has a sort of a more supportive regulatory environment. But anyone who's looking at it would need to consider some of the topics we said earlier, of free float, of control, market cap, of directors. So they are quite different.
Great, thank you very much. I've got one here previously came in here. Is this a good time to go for an IPO in the UK? Is this a good time for an IPO? Anybody?
I think it's a good time to plan for an IPO. As I said earlier on, the most IPOs probably are going to take 6 months to plan and probably 3 or 4 months to progress. If I knew when was a good time for an IPO, I wouldn't be sitting here. I'd be sitting on a beach somewhere. But I think now is a good time to plan. I think what we tell clients to be prepared, but be flexible. So I think I think you could plan now for an IPO sometime next year, depending upon the size and stage of the business. I think just keep options open as regards timing and whether you do an IPO or whether you look at maybe a private equity play first, but always good to plan.
Great, thank you very much. Here's one as well, so from Shankar. What is the difference between standard listing and main listing on the LSE? Okay, I can see you're all gagging to answer that one. So therefore, Ollie or Joe, who would like that one? What's the difference between standard listed and main listing?
Happy to take that one, David.
Thank you.
Largely, this was part of what was intended to be covered in the presentation earlier on. I mean, the purpose of the AIM segment for growth companies, it has a different structure for how to enter that market, and also the fees that are chargeable for being listed on that market. So there's a number of differences, but I think it's essentially what we see is that larger, more established companies tend to be better suited to the standard segment, and earlier stage companies more to the higher growth AIM segment.
David, if I could just come in there as well. There is, of course, if one's looking for a healthy number of retail investors, as regards the UK, there can be significant tax advantages for UK investors investing in AIM companies, which are not available for companies on the official list, whether it be premium or standard segment.
Excellent. Thank you very much for adding that, Clive. I'm going to kind of combine two from the specific questions that came in beforehand, because they relate to Hong Kong. So what's the difference essentially from doing an IPO in Hong Kong and in London? So Hong Kong, London. What's good, what's bad? Why London? Anybody?
I'm happy to go first, having had some experience. I think overall it's fair to say that the processes used by Hong Kong are very similar to those used by London. They both started with very similar rule books, although Hong Kong has evolved quite a lot in the last 30 years. The main difference is, I think, the cost and the timing. So it's been very difficult to do an IPO in Hong Kong in less than a year, maybe even more than that. It's a much more expensive process, but of course, what you'd argue is that if your business is very Asia focused, very Asia centric, then you're picking up maybe investors in China more easily than you would in the UK. But the actual processes involved of a listing there, in terms of rule books, are very close to the UK. But I'd say longer, more expensive, and probably more lawyer driven, which would be good news for Clive.
Absolutely. But we're not for me, because we don't have a Hong Kong office.
No, indeed. But I think yeah, I'm not here to sort of criticize, to compare one with the other in terms of what's best. It's really, most companies are actually self choosing. Really, it'll be obvious which companies really would get more benefit from a Hong Kong listing, and which would get more benefit from the international listing in London.
If I can add to that as well, one of my clients has just moved from AIM to the main market in Hong Kong. And if you're taking a typical AIM company versus a typical sort of main board Hong Kong company, then the requirement's quite difficult. It's quite a high entry threshold into Hong Kong, as Robin said, as well as the time and the cost. There's also a difference in approach from the regulators. Whilst the rule book remains the same, that the Hong Kong Stock Exchange take a very hands-on view of the listing sort of committee to reviewing the documents, and it takes a long time to get those documents through, and the granularity, I think, is different to AIM. Whereas with AIM, it's the nomad who then liaises with AIM regulation to get the document approved. Yeah, small.
Great. Thank you very much. It's just a quick one here. It's from Rab. Are there many companies who initially list on AIM, then go on to list on the NASDAQ? Ollie, might that be one for you? Many companies who list on AIM then go on to NASDAQ.
Yeah, I don't have the statistics at my fingertips for that, but yes, that is something that has happened, particularly in technology companies. So they've gone for the AIM market to support their initial growth, and then have moved forward into a US listing. So yes, it has happened.
May I also add to that? Actually, we've had 4 clients that have done that. So we're quite experienced. Some remain dual listed, and some move to NASDAQ and come off AIM. It's actually quite an easy process. And what we do find is that we're seeing more in healthcare than we are in tech. But it's those types of companies are moving where the entry bar again onto NASDAQ is quite high. So they come to Europe, they get established, they build up their business, they raise the funds they need, and then they go and seek that dual listing. Normally it's sort of the 100 to 200 million plus valuation level. which these can't get away as a direct IPO on NASDAQ.
Excellent, thank you. And the last question I'm going to pull forward here, because there's a number on the similar theme, it's all about costs. So what might be some of the average costs involved in listing on the stock market? Who would like to start us off with this one, please?
Well, I can go first if you like, David, and others can add to it. I think the cost in London and Singapore and Hong Kong have a similar structure. There's a what I'd call a process due diligence cost involving nomads, corporate advisors, lawyers, accountants, and there's a broking cost or fees in relation to that. Typically, if you look at the records in London, the overall percentages vary from somewhere like 7% to maybe 10% of the funds raised. But it's one of those things whereby the more you raise, the lower the percentage is. So there's a hardcore of fees which are based on lawyers, accountants, and nomads, and then there's the brokerage fees. What I would say is that in terms of the exposure to costs, if the transaction doesn't happen, most lawyers and accountants and some nomads would have some form of fee abort arrangements. So you'd have to look at in each case to see what the exposure was. But I think also a good way of looking at it is in terms of comparing it with somewhere like Singapore and Hong Kong. If you compare the issue costs of those three markets, Hong Kong would be more expensive in terms of admission. Singapore would be more expensive in terms of the ongoing obligations, and London would sit probably in the middle of both. So I think overall, I think as long as you've got a good reason to raise the money, the costs are not extortionate, and they're manageable, and obviously give you the opportunity to grow.
I've probably just got one comment to add to that, if I may. Slightly esoterically, but there probably are certain things that can be done from the structuring side to just limit the potential abort costs. One obvious thing that you'd be surprised how often it doesn't happen is actually an early stage when the process is getting up and running, the pre-IPO processes, actually to make sure that you set up a private holding company if you're using Jersey. So, that enables probably some of the corporate approvals to run more smoothly. It also means that you're not triggering things like annual audit requirements, but the company can still contract in its own name. So, that conversion to from private to public does need to happen. It needs to be a PLC at the time of the listing, but you just want to time that before you trigger in those additional costs and commitments to audits and other things, because even if the IPO doesn't go ahead, you don't get out of having your audit done, and you don't get out of your public company filings. So it's a small point, but just a planning point to help limit abort costs or the potential exposure to abort costs.
Excellent. Thank you very much. I'm going to close us down there. We've run a couple of minutes over. I thought it was a fantastic webinar. I mean, so many questions submitted beforehand, nearly 20 questions during it. So a big thank you to all the attendees. It's been a pleasure, obviously, working with Ollie, Joe, Robin, Clive, and Gavin. Certainly learned a lot, and this is very strong and good for international trade for the UK and our international colleagues in Malaysia and elsewhere. And a big personal thank you from me to our tech crew of Joshua and Stephanie. So thank you, everybody, for that. Thank you, panel. We did great on the timings, enormous amounts of information there, and you've said that we can share the information, so that's great. So let's hope it further builds these bridges between our countries and UK PLC and the rest of the world. It's now my great pleasure to invite back the illustrious chairman of the British Malaysia Society, Maysim Lai, OBE-DL. Maysim. You're on mute at the moment, Maysim.
Okay.
Over to you, Maysim.
Thank you so much, David. So what is coming up next? So you can see on the slide that we have the IGM 2020 event, which is an exhibition and conference on green tech and eco products. Our partner in Malaysia, BMCC, is a delivery partner for this event. So if you're interested in having more details, please contact Jennifer Lopez of BMCC. So as far as BMS events coming up are concerned, our next event, which would be of interest to a business audience, is the G5 event on the 27th of October that we are doing with the Institute of Directors and EY. We also have a few events.
Yeah, next slide, please, Joshua, thanks.
Which are part of our corporate social responsibility work that we do to help Malaysian students in the UK. And if you can see on the slide, we've got mentoring, smart networking, employability, and internships, including virtual internships. So again, they are open not just to students, but to anyone who's interested. And then finally, just a word about BMS and joining BMS. I would invite you all to join BMS if it's of interest. You can sign up very easily on our website. It takes about 5 minutes, and you do not have to be based in the UK or Malaysian to be a member of the British Malaysian Society. So finally, may I end by thanking the brilliant panel of speakers. They've got top marks for content today. And also everyone involved with delivering this webinar. So David Stringer-Lama, our chairman, and also the Zoom technical chair, and also his team, Stephanie and Joshua. And thank you all so much indeed for attending this BMS webinar, and we look forward to seeing you at future BMS events. Thank you.
Excellent. Thank you very much, Mei Sim Lai. And you just see up there the ways you can engage with us, our various feeds, Twitter, Facebook, LinkedIn. On behalf of the BMS team and the panel, thank you ever so much for joining us. And we look forward to seeing you at our next event, our next webinar. Thank you very much. Have a good rest of the day or the evening. Goodbye.
Well done, David and the panel.